Hello everybody and welcome to the video. My name is Brandon and today we're going to be going over how to start investing in 2018 as a complete beginner, or as the kids like to say these days, as a noob. And before I get into the video, I of course need to take a quick second and give a huge thanks to Mr. Ryan Scribner. Guys, he was truly the one that inspired me to get into YouTube. You know, he's been an absolute role model to me. He's someone that I very highly look up to. So to be featured on his channel like this, I can't even begin to express how much that means to me. So Ryan, as you already know, my man, thank you, bro. And thank you to everybody that's watching this video. I really do appreciate all your guys' time, and I hope that you guys are able to get some good value out of this video. So how this is going to work is that we're going to be breaking this down into three main sections. We're first going to take a look at what you need to do before you invest. We'll talk about what to expect when it comes to investing. We'll look at getting your financials in order. Then we'll touch on choosing your broker. So this is actually where you're going to be hosting your investment account. Then we'll go on to talk about getting your investment account set up. Once we've got that out of the way, we'll move on to the second component of the video, which is actually the investment aspect. We'll look at establishing what we're going to call your asset allocation, which is essentially the targets or the guidelines that you're going to be aiming for with the money that you're investing. We'll then take a look at the different investment options that you have: stocks, bonds, index funds. We'll look at the pros and cons of each and see which is the most suitable for you. Finally, we'll move on to the last section of the video. It's what to do after you've got your portfolio up and running. So once you've made your first investments, you have to make sure that you're keeping up with your portfolio. This would involve monitoring your investments, learning how to rebalance your portfolio to make sure that you stay on target, and putting money away on a consistent basis to continue building up your wealth. So without further ado, guys, let's get on with the video. Again, I thank you all for watching, and I really do hope you enjoy. So first and foremost, we're going to talk about what to expect when you invest. And you know, some very common questions that you'll hear from new investors are things like, well, is investing risky? Or am I going to lose my money in the stock market? And those are actually two very good questions. And a lot of new investors would actually be surprised to hear that if you invest properly, you should not lose any money. Now, let me rephrase that so I don't cause any confusion. The value of your account will absolutely fluctuate. You know, when you're investing in assets that every day are going up and down in value, there are going to be periods of time where your returns are not so favorable. But keep in mind, guys, you haven't actually ever lost money until you decide to sell your investments at a loss. And to explain this, let me bring up on the screen here a chart that actually dates back to 2008 and 2009. And this, of course, guys, was the financial crisis. This was actually the most recent stock market crash that we've experienced. You know, you may have seen the movie The Big Short. Well, that was based off of this. And guys, this was actually a very scary time for some investors. It was the largest recession that we've seen since the Great Depression back in 1929. Stocks lost 40 to 50% of their value. A lot of investors lost a fortune. You know, some of them half of their retirement savings during the stock market crash because they got scared and they sold their investments at a loss. But Brandon, I thought you just said investors can't lose money. Well, what I credit this to is them coming in with the wrong expectations. In my opinion, investors that lost money during this crash were uneducated and didn't have a proper understanding of how the markets work. Because as devastating as this market crash was, we take a second here to look at the bigger picture. And what we're looking at here is the performance of stocks and these other assets over the long term, so dating back to 1926. And looking at this chart, what is the first thing that we realize? Stocks, the stock market, these assets, they appreciate and they grow over time. Now, it is absolutely not a smooth ride, as we can clearly see. But guys, as time goes on, things move in this direction. And if we were to project this chart 30 to 40 years out, this is exactly what we could expect to see. And the financial crisis that we just looked at that was so devastating, well, that is this right here. So it doesn't seem so bad in the big scheme of things. So what I'm trying to get at here is that as an investor, there are going to be periods of time where your investments are down, and you have to be okay with that. Just understand that these short-term fluctuations, these temporary pullbacks are absolutely normal and they are nothing to be scared about. And just for your reference, you know, what type of returns can you expect as an investor over the long term? I always like to say right in that 7 to 8% range. And where do I get this number from? Well, as we'll look at later in the video, the S&P 500 index, which is essentially the 500 largest companies in America, this index grows at about that rate. And again, we'll touch on this more later in the video, but I think that 7 to 8% is is a very reasonable rate of return that you can expect. And just to clarify here, that does not mean that we would expect to see exactly 7% growth every year. We think back to that chart that we just looked at, guys, and investing in the stock market can be quite volatile. So the average rate of return evens out to be about 7 to 8%. But guys, the returns could be all over the place. Some years you'll see gains of 20%. The next year very well may be down 20%. You just need to come in with that long-term mindset and understand that yes, over the short term, things may be volatile, but over the long term, you stay invested, you're gonna make some good money. And as I like to say, you just gotta trust the process.
Trust the process?
Thanks, Joel.
Oh, see now Simmons in transition. What a pass to Embiid! My goodness! Posterizes Baines.
Now, once you've got that engraved in your mind, that investing is a long-term game, the next thing that you need to do is get your financials in order. And there's really two main things that I want to talk about in this section. The first is setting up what's called an emergency fund. And this is what all the experts will recommend that you do before you invest. You never want to have all of your money invested in the stock market, because if for whatever reason you may need some of that, and if it just so happens to be that the markets are down, well then what happens is that you may be forced to sell at a loss to get some of that cash. So what the experts will always recommend is that you keep 3 to 6 months worth of living expenses held on the side. And that would be in a separate account, either held in cash or maybe invested very conservatively, so in an investment that's highly liquid, meaning that it's very accessible for you. Now, whether you decide to do this or not, the choice is up to you. And I'll be completely honest with you guys, I don't currently have an emergency fund. And the reason behind that is, I think that this becomes much more important, the older that you get. If you're someone that has people depending on you, we think of maybe you have children or you have a family to support. If you were to, God forbid, lose your job, well, that would be detrimental. And, having this emergency fund where you have cash set aside would be huge for a situation like that. As a younger person, I don't think it's as big of an issue, but that's just strictly my opinion. But the second thing that is an absolute must, no matter how old you guys are, is to pay down any high interest debt. And this would be something like a credit card balance, or maybe you've taken out a cash advance or a high interest loan. It really doesn't make sense if, in your investment account, you're earning 7 to 8%, yet you're paying 21% on, an outstanding credit card balance. There's no question about it. You're absolutely going to want to pay those debts down before you get into investing. Now that we got those out of the way, the first real decision that you have to make as an investor is choosing your broker or your brokerage. And this is essentially where you'll be hosting your investment account at. And you really have two options as to what you can do here. The first option is to go the traditional route. And this would be going to somewhere like a bank or an investment firm. And with this option, you'd be linked up with an investment advisor. So if you're somebody that wants the guidance, you want help with your portfolio, you want to build a relationship with an advisor, with a professional going forward, I think that this is a great option for you. And I am a huge advocate of working with an advisor. If you can find a good advisor, they can bring you so much value if you're able to find a good advisor. Now, the second option that you guys have, which is very popular nowadays, is to go with an online broker or a discount broker or, a self-directed account. And those words can be kind of used interchangeably. And with this option, you guys would not have an investment advisor. So you would be completely on your own. You'd be the one making all the investment decisions. You'd be the one that's in control of your portfolio. So if you're somebody that knows exactly what you want to buy, you don't need the help of an advisor, this would be a great option for you. And I'll go out on a limb here. As viewers of this video, you're eager, you're self-educating right now. So I'll assume that this is likely the route that you're more interested in. Now, which is the best broker to go with? That's a tough question to answer. I'm over here in Canada, and the platform that I always like to recommend is Questrade. I think it's a great all-around platform. It's very simple to use for beginners. They have very low commission costs. So when you buy and sell stocks, you pay a little bit. Those commissions, I think, are as low as $4.95 per trade. It's the platform that I use. Over in the States, I've heard Robinhood is a great platform. You don't even have to pay commissions on the trades that you make there. TD Ameritrade, these are both two, I think, great platforms. And I definitely recommend you look into these more because, I can't talk from experience there and give you guys a good recommendation on which is the best broker to go with in America. And just to clarify here, this is where you'll be hosting your investment account at. So if you decide to go with Robinhood, well, you're gonna have a Robinhood investment account. If you decide to go with Questrade, you'll have a Questrade investment account. They're just equivalents of each other. It's the same as saying, well, should I bank at TD Bank or Royal Bank or JP Morgan or Citigroup? Now, once you've chosen your broker, the next step is deciding what type of investment account you want to open, because there are all types of accounts for you to choose from. And again, just to clarify here, your investment account is very similar to a bank account. You fill out the paperwork, you open it up, but with an investment account, you're actually eligible to hold stocks, bonds, mutual funds, ETFs, pretty much any investment vehicle that you want, which is something that you can't do in your bank account. So what you'd be doing here is that once your investment account is opened, you would essentially be either transferring or depositing money in from your bank account. Once the money's in the investment account, then you can go ahead and buy pretty much whatever investment asset that you want. And like I said, there are all types of investment accounts that you can choose from. Again, here in Canada, you have the RRSP, the TFSA, you have cash accounts, margin accounts, but the account that I always like to recommend for beginners or for new investors is to go with the TFSA, the tax-free savings account. And as the name implies, this is an account with very few tax complications. You pretty much just pop money in, you can buy and sell stocks, you can let your investments grow tax-free, you can make withdrawals tax-free. It's just an all-around great account for a beginner. And the closest equivalent to that over in the States would be the Roth IRA. And I apologize that I'm not going to be going into any more detail about the different accounts because this really is a personalized matter. Your circumstances, your financial situation all comes into play, and there isn't necessarily a right or wrong with which account to go to. It's tough to just give a blanket recommendation and say, hey, this is the best account to use for you. But what I would highly recommend is to go do a little more research online. There are a ton of resources, whether that's on YouTube or Googling, the pros and cons of the different investment accounts and seeing which is the most suitable for you.
It's not unusual to be loved.
So let's make our way onto the second section of this video. It's probably what you guys are all here for. It's the nuts and bolts of building your portfolio. So let's assume that at this point you've chosen your broker, you've set up your investment account, whether that's the TFSA, the Roth IRA, a cash account, and let's assume that you've now funded your account. So you've popped some money in and you're ready to invest. Now, before you go out and start picking random stocks, because that's probably not the best strategy for you, you're going to want to establish what's called your asset allocation. And your asset allocation is essentially the guidelines or the targets as to how your money is going to be invested. And let's backtrack a second. When you want to invest, there's really two types of assets that you can buy. You have stocks, and then you have bonds. And a lot of new investors, a lot of people that aren't really in the investing scene, they often think that these are the same things, right? Because growing up, you always hear stocks and bonds, right? Jimmy, how's your stocks and bonds doing? Hey, stocks and bonds. But guys, these are two completely different assets with two completely different characteristics. So when we invest in stocks, we are buying shares of publicly traded companies that we see around us every day, Coca-Cola, McDonald's, Walmart. And when we invest in these companies, we would expect to see some growth. There's the potential to make a lot of money, but at the same time, you'd also expect to see a higher level of volatility. That's the characteristics of investing in stocks. Now, when we invest in a bond, what we're actually doing is we're lending our money. We're either lending our money to a company, to a bank, to the government, and in return for lending our money, we're going to be receiving an interest rate. It's almost like the opposite of a loan. So with a bond, you would expect a very consistent stream of income, but not a whole lot of growth. It's kind of capped out, the return that you're going to get. So a bond would definitely be considered a safe investment. And typically what investors would do is they'd have a combination of both some stocks and some bonds. So essentially what your asset allocation is telling you is how much do you want to have invested in stocks, or equities we'll call it, which is the growth component of your portfolio, and how much do you want to have invested in bonds or fixed income, which is the safety, the conservative part of your portfolio. Now, what is the best asset allocation for you? Well, that depends. How old are you? How long do you plan to invest for? How much risk are you willing to take in terms of volatility? What are your specific financial goals? I mean, all of these questions come into play. But one of the classic methods of figuring out your asset allocation is by using what's called the age method. And how this works is that you take the number 100 and you subtract your age, and that gives you your weighting to equities or to stocks. So everybody get their calculators out. We got some big numbers to crunch here. Let's say, for example, you're a 20-year-old that's looking to get into investing. You take the number 100, you subtract 20, and 80% would be your target to equities or to stocks. In other words, you'd have an 80-20 asset allocation. That would be your portfolio balance. Now, another example, let's assume that you're a 40-year-old watching this video. Well, in that case, you would take the number 100, you would subtract 40, and that's a 60-40 portfolio or a 60-40 asset allocation. So this is a very simple way of getting a good ballpark idea of what your portfolio should look like. Now, keep in mind here that the higher the weighting you have to equities, the higher return you would statistically expect over the long term. But with that would come a higher level of volatility, or what some people would like to call a higher level of risk. Now, we'll take a look at this. We think of an investor who's in their 20s. They have decades and decades ahead of them in their investing careers to outlive any market corrections. They're at a point in life with very few expenses, and they should absolutely be concerned with growing their portfolios. That is their goal at the moment. So a younger investor should absolutely be taking advantage of their time horizon and striving for higher returns. In other words, all else being equal, a younger investor should have a higher weighting to equities. Whereas somebody that's a little bit older, let's say in their 50s or 60s, maybe they're thinking about entering retirement in the coming years. Let's say they've built up a nice portfolio over the years. Maybe at this point in their life, they can't afford to live through another market crash because they may not have the time to let their investments recover. So typically, as you get older, you tend to become a little more conservative, and that's why it would be prudent for an older person to have a higher weighting to bonds or fixed income, where they'd be receiving a very predictable and steady stream of income. They wouldn't be overexposed to the equity markets in the case of a crash. It would be much more of a conservative portfolio. So ultimately, the decision is yours with what asset allocation you want to go with, but I do think that using the age method is going to be a great starting point. Now, a question that you'll commonly hear from investors is, do you need to invest in bonds? And I think that this question is worth addressing. And the answer to that, in my opinion, is quite simple. Yes, you do. Bonds are a very important part of a well-balanced portfolio. Not only because they provide you with income, right, from the interest that you're receiving from the bonds, but more importantly, they act as a hedge or a buffer during a down market, which really helps with stabilizing out your portfolio. You look at historically, when the stock market crashes, bonds have typically performed fairly well. They almost work opposite of each other's. And the reasoning behind that is that when the stock market is crashing or performing poorly, it's very common that you would see investors selling their investments and cycling their money into a safer asset like gold or bonds or fixed income, which then drives up the price. The term for that you'll hear is flight to quality or flight to safety. So having that aspect of bonds in your portfolio is really going to help with smoothing out the ride, and I think that bonds are an essential part of any portfolio. And if you're a little bit of a smart aleck and you've done a little bit of homework, you may be able to make the argument that, from a statistical standpoint, being 100% invested in equities, so all stocks, will technically give you a higher return over the long run. And from a strictly statistical standpoint, that would technically be correct. But guys, investing is so much more than just a game of numbers or a game of math. We have emotions that come into play. And rather than striving for all-out returns and trying to inch out every percentage that you can, it's often wise to give up, some of that growth for the downside protections that bonds offer. So keep that in mind when you're choosing your asset allocation. Now that we've got your asset allocation set with whatever you decided to go with, the next step is choosing the actual investments that you're going to be buying. So let's assume that you decided to go for a 60-40 split, and let's say you have $10,000 to invest. That means that of that $10,000, your targets are to have 60% of that, so $6,000 invested in stocks, and 40% of that, or $4,000, invested in bonds or fixed income. Now, the first option that you have is to go out and buy these stocks directly. And as much as you guys are not going to want to hear this, for a beginner, this is not the method that I would recommend. We have to keep in mind that as investors, one of our primary concerns is achieving a good level of diversification. And diversification in simple terms is not putting all of your eggs in one basket. You want to spread those eggs, or you want to spread your investments, amongst all the different areas of the economy, right? You want to invest in multiple sectors, you want to invest in multiple stocks. And you never want to have too much of your money invested in one area. And the reasoning behind this is that, the economy is constantly going through its cycles. And this year, this stock or this sector may be the hot sector, energy stocks are on fire. Come this exact time next year, guys, it could be a completely different picture. And energy stocks or tech stocks or whatever the case may be the worst performing stocks, in the stock market. So rather than trying to essentially guess and gamble on, where the best places to invest are, one of the better strategies that you can implement is to diversify and do your best to get exposure to all of the different sectors so that as the economy grows, you'll partake in those gains and you'll never be overexposed to a specific sector or a specific stock if that sector happens to get slammed.
Let us rethink old assumptions and open our hearts and minds to possible and possibilities. God bless you. God bless Israel. God bless the Palestinians. And God bless the United States. Thank you very much. Thank you.
So yes, you could go out and pick yourself a handful of stocks, maybe pick 2 or 3, McDonald's and Procter & Gamble, Microsoft, pick a few stocks that you think are going to do well in the future. But, we ask yourself this question, we just talked about the importance of diversifying. If you pick yourself, let's call it 3 or 4 stocks, are you really that diversified? And the answer to that is actually not at all. All of our investments here would be concentrated within 2 or 3 stocks. And I don't care how good the company is, that's just too much risk concentrated in one area. If something were to happen to one of those stocks, whether that's, a big drop in the share price or, worst case scenario, the stock goes bankrupt, guys, that's a large percentage of our portfolio. And that's why for beginner investors, especially if you don't have a large sum of money, in other words, you can't build a diversified portfolio of going out and buying individual stocks directly, I would absolutely recommend investing in a diversified fund like an index fund. And an index fund, whether that's a mutual fund or an ETF, is essentially just a bundle or a basket of stocks or a basket of assets. And one fund can contain multiple companies. Certain funds will contain 50 companies or 50 stocks. Some funds will contain 100 stocks. Some funds contain upwards of 1,000 stocks. And there are all types of different funds you can choose from. You can invest in gold funds, which would contain gold companies. You can invest in European funds or Asian funds. But in my opinion, the best type of fund that you can invest in is a fund that tracks the S&P 500 index. Now, as I touched on in the beginning of this video, the S&P 500 index is essentially the 500 largest companies in America. So included in this index, you'd have, the Apples, the Amazons, Googles, Facebooks, Walmarts, all of the big blue chip companies are going to be included in this index. And as you can imagine, if you invest in a fund that tracks the S&P 500, well, that's a great level of diversification right there to some of the greatest companies in the world. And this right here is an example of an index fund. So we're looking at the Vanguard S&P 500 Index ETF or Exchange Traded Fund. The ticker here that you're looking at is VFV, or in the US, it's VOO. And Vanguard is the company that packages up these products, they package up this ETF, and we can invest in them. So this is one of the investment products that they offer. And an equivalent to this would be the SPY. So a different company, but an identical fund. And basically what these funds do is they attempt to replicate the performance of the S&P 500 index. So we can scroll down here to take a look at the top 10 holdings in this fund. Currently, we're looking at Apple, Microsoft, Amazon, Alphabet, which is the parent company of Google, Facebook, JP Morgan Chase, Berkshire Hathaway, Johnson & Johnson, ExxonMobil, Bank of America, and these are just the top 10 of 500 holdings. So by investing in this ETF, you're inherently investing in 500 different companies, and this would be an exact replication of the S&P 500 index. We can have a scroll down here to see the sector breakdown, and by investing in this one fund, we have a very diversified exposure to the different sectors: infotech, financials, healthcare, consumer discretionary, industrials. And what's so great about an index fund like this is that we can scroll up and we can invest in all of these companies, all 500 of these great companies, for currently $63. That's how much it costs for one unit, or technically speaking, one share of this ETF. Now, an important thing that needs to be mentioned up here is the MER, which stands for the Management Expense Ratio. And what this is essentially the fee that you're going to be paying to invest in this fund. And any packaged fund like this that you invest in is going to have some sort of fee, some more than others. So what this is telling us is that for every $100 that you invest in this fund, every year you're going to be charged 8 cents in fees. So extremely low cost, and one of the major benefits of investing in a low cost index fund. And guys, I'm not necessarily saying that you need to go out and buy this ETF. Absolutely not. I just wanted to show, through this example, the true power of an index fund and how great they are at achieving a good level of diversification and why they're so important for beginners. So ultimately, it's up to you with what funds you decide to go with. Of course, you need to go out and go do your own research and find funds that are suitable for you. But my recommendation would be find a fund that invests primarily in US companies or a fund that invests, in the S&P 500 index. And then for the fixed income component of your portfolio, you could go out and find a bond ETF or a fixed income ETF, which is essentially just a fund that instead of investing in stocks, invests in a group of bonds. And I'll link some ideas in the description for you guys below. And here are a couple examples of some sample portfolios that may give you some ideas. Once you guys have chosen the funds that you want to invest in, you've purchased your first investments, investing does not just end there, all right? In fact, things have just begun and you've got a long investing career in front of you. The first thing that you're gonna need to learn how to do is to rebalance your portfolio. And as time goes on and the different investments or the different funds grow at different rates, you may take a look at your portfolio and things may be completely out of whack. Your targets may have been set at 60% in equities, 40% in fixed income, but a year later, if stocks have been performing very well, it's very likely that these funds may now represent a bigger part of your portfolio. It's very possible that the equities may now represent 70% of your portfolio and bonds, let's say 30. So this would call for a rebalancing. And rebalancing is extremely important because what it does is it helps provide discipline to your investment plan. You set these targets for a reason. You want to stick to them. And it's very tempting to let a hot stock or a hot fund or a hot investment run. But guys, more often than not, after a stock has done very well and it now represents a larger part of your portfolio, it's very common that you'd see some sort of reversal or some sort of pullback. So one of the best things that you can do is learn how to take profits and reinvest those profits back into areas of your portfolio that aren't doing so well. So in the example that we just looked at there, it would be as simple as, trimming back and selling some of your equity funds and reinvesting that money back into the bond funds. And typically, you'd want to rebalance no more frequently than I like to say once a year. I get it. It's very tempting to want to, micromanage your portfolio, but more often than not, a better strategy is kind of just to sit back and let them do their thing. Not to mention, if you're the type of person to be constantly buying and selling stocks, you're going to be paying a lot in commissions, which is going to eat away at your long-term returns. So avoid that as much as possible and only rebalance when you have to. And the final thing that I want to talk about in this video, the final thing, man, we're almost done. If you've made it this far, we're almost done, I promise, is learning how to put money away on a consistent basis. It is not enough to invest one time and expect that to provide for your retirement. Absolutely not. All right, you need to get into the habit of putting money away on a consistent basis. In my opinion, one of the best things that you can do is put money away every month. Even if it's a small amount, you'll be surprised at how much of a difference that makes over the long run. I personally like to use a system called a PAC, which stands for pre-authorized contribution. And you'll hear different names for this depending on, where you decide to invest. But essentially what this does is that, every month, right when I get my paycheck, it automatically sends money from my bank account straight into my investment account. So it just pops it over. I don't have to make that conscious decision about, oh, do I need to save this month? No, right? It's coming out whether I like it or not. Not to mention when you're putting away money every month, you're actually doing something called dollar cost averaging. And what that is basically you know, if you're putting away a set or a fixed amount, whether that's $100 a month, whether that's $500 a month or $1,000, and you're buying units or, you know, shares of your funds, basically what happens is that, you know, as the stocks get more and more expensive, with your fixed amount, you're going to be buying less and less shares. And when the stocks go down, you actually end up buying more shares at a cheaper price. So you're acquiring more and more units or more and more shares when these stocks are trading at a discount. This is a strategy that's going to do you wonders over the long term. So guys, we have made it to the end of the video. I hope you guys are still with me here. Some of you guys, if you are, man, thank you for watching the video, and I really hope that you were able to get, you know, some good value. I hope that I was clear and kind of informative. I do think that, you know, from the stuff that we covered in this video, that is going to give you a nice base of knowledge to go out and start investing. And the important thing, you know, that I want you to take away from this video, if there's one thing to take away, is, you know, just go out and start investing. You know, go to your bank, go to an investment firm and set up an appointment, or go open an account and just go out and start learning, man. Start experimenting, because investing is truly fun and important. And, you know, as scary as it may seem, I promise you, it's not so bad. So I thank you guys all for watching. Again, Ryan, my man, thank you. I, honest to God, cannot thank you enough. Seriously, dude. If you guys enjoyed the video, you can feel free to give it a thumbs up. And if you guys have any questions or comments, be sure to leave them in the comments below, because I'll do the best that I can to help you out and answer them, you know, to the best of my abilities. And as always, I thank you guys for watching. I had such an awesome time creating this video, and I hope to see you guys in the next video.